By the end of July 2025, global trade experienced a significant shift, particularly in the relationship between the United States and major trading partners, including the European Union and Canada. U.S. President Donald Trump, known for his tariffs-first, negotiations-later approach, secured a framework agreement with the EU after weeks of tension.
And $600 billion worth of investments into the United States over and above what they have. And I think that basically concludes the deal. I mean, those are the main factors. I don't think there are too many other factors, other than we're going to get along great.
A 15% tariff on most products imported from the EU was the central element of this deal. The EU agreed to this deal in an effort to avoid a full-blown trade war, which would not only harm their economy but also disrupt global supply chains. However, even after reaching an agreement with the EU, the Trump administration continued to pressure Canada, threatening to impose a 35% tariff on imports from Canada unless a trade deal was finalized soon. What's particularly noteworthy is that while the EU made concessions and signed the agreement, Canada took a different route. Canadian Prime Minister Mark Carney rejected Trump's proposed trade deal. Moreover, Carney publicly expressed Canada's reluctance to accept terms that would be unfavorable to the country, even as the U.S. increased pressure through tariffs. Carney's rejection of the trade deal wasn't an unexpected decision. Since taking office, Prime Minister Carney has demonstrated a clear strategy focused on protecting the nation's interests. This is evident in his firm stance against accepting agreements that don't benefit Canada, even though trade negotiations between the two countries are happening in an extremely tense atmosphere. In interviews, Carney emphasized that Canada will not sign a deal unless it safeguards our economy and national interests. This approach has helped Canada avoid getting stuck in vague agreements, unlike what happened with the EU and Japan. Carney has made it clear that despite pressure from the U.S., Canada will not blindly make concessions. Instead, he has chosen to protect strategic industries like automotive, energy, and digital trade. Carney rejected the U.S. demand to expand access to the automotive market with high tariffs. The Canadian automotive industry contributes $70 billion to GDP and provides 500,000 jobs, so Carney could not accept terms that could weaken this sector. Carney rejected the agreement that would require Canada to sell oil and gas at 20% below international prices. The energy sector is worth approximately $50 billion annually, and rejecting this deal protected Canada's long-term benefits from its natural resources. Carney rejected the U.S. request to open the market to American tech companies and allow them to collect data on Canadian citizens. Canada's technology sector contributes $40 billion to GDP and creates 200,000 jobs. This agreement could have weakened the competitiveness of Canadian tech companies. Carney rejected the U.S. demand to fully open Canada's financial and manufacturing sectors to investments, which together contribute $150 billion to GDP and create 1 million jobs. Over-opening would reduce the control Canadian companies have in their own economy. Carney rejected the demand to reduce export taxes on agricultural products from the U.S. to below 5%. The agricultural sector contributes $60 billion to GDP and provides 300,000 jobs. Reducing taxes too much could have hurt the competitiveness of Canadian agricultural products. By rejecting the trade deal with the U.S., Carney opened a new direction for Canada, one that no longer depends on trade agreements with the United States. Canada has focused on developing its Arctic resources, which include 90 billion barrels of oil and gas, infrastructure and oil and gas projects worth $10 billion in cooperation with Japan and South Korea are set to begin in 2025. This will not only help Canada assert control over the region, but also enable it to provide energy to countries in the area. Canada signed a $20 billion energy agreement with China and Japan, reducing its dependence on the U.S. Major tech companies from Japan and South Korea have invested $10 billion in R&D projects in Canada over the past 5 years, further boosting the high-tech industry. Carney's leadership has helped Canada decrease its reliance on the U.S. while building new partnerships. The Arctic initiatives and collaborations with Asia have created $30 billion in investment and trade opportunities for Canada, solidifying its position in energy security, resource extraction, and high-tech industries. Canada has ramped up its exploration of renewable energy and oil and gas, with reserves totaling 170 billion barrels. Canada exports 120 billion Canadian dollars in energy each year, with 50% of its oil exports going to the US, but has also signed energy deals worth $20 billion with China and Japan. In the high-tech sector, Canada attracted $10 billion in investments from Japan and South Korea over the past 5 years, focusing on artificial intelligence and IT. The energy sector contributes 10% to Canada's GDP, while high-tech contributes 4 to 5%. These investments provide stable revenue and boost Canada's global competitiveness. The Bill C-5 project, Economic One Canada Act, was launched to develop infrastructure and create economic opportunities for the Arctic region, particularly for Inuit communities and other Indigenous groups. The project includes 6 billion Canadian dollars for transportation infrastructure, with 2 billion Canadian dollars allocated to building roads and ports. Additionally, 1 billion Canadian dollars will be invested in renewable energy projects such as wind and solar. The project also dedicates 1.5 billion Canadian dollars to initiatives that promote economic growth in Indigenous communities, creating 10,000 jobs for Inuit people. These investments will not only drive economic growth in the Arctic, but also reduce reliance on other developed regions, enhancing Canada's position in resource extraction and regional security. The EU chose to make concessions and sign a deal with the United States to avoid a full-scale trade war. This decision was not easy, but represented a calculated strategy aimed at safeguarding the EU's interests in an unstable global economy. The agreement between the EU and the US includes a 15% tariff on most products imported from the EU. While this tariff is far lower than the 30% one Trump had previously threatened, it still significantly impacts the EU's key industries. These industries include: the EU is one of the world's largest car manufacturers, with brands like Volkswagen, BMW, and Mercedes-Benz. The EU's auto industry relies heavily on exports to the US. A 15% tariff could increase production costs and reduce the competitiveness of EU cars in the US market. The EU conceded to avoid higher tariffs, which could have severely cut car exports to the US. The EU exports many agricultural products to the US, including cheese, wine, and meat. A 15% tariff could raise the price of these products in the US, affecting market share for EU producers. High-value exports like wine, olive oil, and cheese will be hit hard by the tariff. The EU is one of the leading manufacturers of machinery and industrial equipment. The 15% tariff will reduce the competitiveness of these products in the US, as the US may seek out alternative suppliers from countries with lower tariffs. To mitigate the damage from these tariffs and strengthen economic relations with the US, the EU has committed to purchasing $750 billion worth of energy from the US over 3 years and investing $600 billion into the US economy. This strategy aims not only to reduce the impact of the 15% tariff, but also to maintain stability in its trade relationship with the US. The EU yielded to Trump's tariffs by agreeing to purchase energy from the US to ensure a steady supply and enhance strategic relations. However, Canada, under Carney's leadership, firmly rejected the deal, prioritizing national interests and refusing to concede to pressure. The question remains, will other countries continue to bend to Trump's demands in the future as protectionist trade strategies become more widely applied?